Okay, I'd like to open up the Audit Committee meeting for the month of April. First thing on the agenda is any public comments.
Yeah, no speakers today, Jim.
Okay. Need approval of minutes. Can I get a motion? Second? All in favor? Carried. Okay, Mike, work plan, please.
There are no changes to the work plan. Our next meeting is scheduled for June 22nd.
Okay, next on the...
Next item, we would like to present management's review of the 2015 MTA Consolidated Financial Statements. And with that, Pat Kane will have a little brief discussion. Pat?
Okay, good afternoon. Okay, today I'm going to review the MTA's consolidated financial statements for fiscal year 2015. This presentation is on page 576 in your in the director's desk book. Okay, MTA financial statements are prepared in conformity with generally accepted accounting principles using accounting standards established by the Government Accounting Standards Board, or GASB. For fiscal year 15, there were several new GASBs that had a significant impact on the MPA's audited financial statements. So I will concentrate on those GASBs today in this presentation. The new GASBs for fiscal year 15 were GASB 67, 68, and 71. The required changes in 67 affected the pension plan financial statements. Those were presented and reviewed at the January Audit Committee meeting. GASB 68 and GASB 71, those affect the MTA financial statements, all the agencies as well as the consolidated financial statements. The big change in these new GASBs, for the most part, is a net pension liability that's now on the MTA's balance sheet. So we're going to see a new net pension liability for 6 pension plans, 3 single employer plans and 3 cost-sharing multiple employer plans, the MTA DB, the NICERS, which is the city plan, and the NICELRS, which is the New York State plan. It's important to note here that these GASBs are specifically about accounting and financial reporting. They have no impact on cash flow. They do not affect the way the MTA funds our pension plans, which has always been to fund at a minimum 100% of the ARC, the annual required contribution. So we have not changed that. Taking a look at our balance sheet, or as known in GASB as the statement of net position, we see the items that were affected by these new GASBs. So we see other assets were affected, deferred outflows for pensions, which is new. The big item in the liabilities is the net pension liability of $7.7 billion. Other liabilities were affected. We have a new deferred inflows from pensions. And of course, all that affects the net position on our balance sheet. So taking a closer look at our assets and deferred inflows, we see other assets were impacted by a $636 million decrease in advances to pension plans as a result of GASB 68. And then we have the new deferred outflows for pensions consisting of $933 million of employer contributions that are made after the measurement date. That's under GASB 71, and then $595 million related to differences between projected and actual investment returns under GASB 68. Taking a look at our liabilities and deferred inflows, we see the big item there is net pension liabilities of $7.7 billion versus 0 the year before. Other liabilities were impacted by GASB 68. And then we have deferred inflows of resources of $952 million under GASB 68. So you can see our total liabilities there increased by $11 billion, or 20%, and the biggest jump in that is the net pension liabilities. Yep.
So what's the match on the other side?
Excuse me?
It's a balance sheet. What's the balancing?
Well, the balancing there is really the next slide. It's
Oh,
it's the
sorry.
net position. In other words, there is no corresponding asset for that.
Oh, all right.
So as the liability increases, the net position goes down.
Oh, fine, okay.
Right.
All right.
So anyway, in our net position, which is our net assets, it's our assets less our liabilities. We have net investment in capital assets increased, our restricted net assets increased, and you can see our unrestricted net assets decreased by $8.4 billion. And if you look on the bottom, that's primarily the net effect of GASB 68 of $6.8 billion. And then, of course, the increase in our OPEB liability, which is $1.5 billion. So those two liabilities are what decrease our net position on our balance sheet. So next, we'll take a look at our revenues, expenses, and changes in net position. We see our operating revenues increased by 5%, $438 million. Our operating expense was $500 million lower, and $419 million of that was because of GASB 68 and GASB 71. So you can see where GASB 68 actually affected our operating results on an accrual basis. If we look at our change in net position, before GASB 68 effect, it was $348 million positive versus a $923 million deficit the year before. So a pretty big swing there of $1.3 billion. Next, we take a look at the GASB 68 adjustment to beginning net position of $7.8 billion. So that's the cumulative effect of GASB 68 on our net position, which really is applied to prior years. Next, we take a look at our cash flow. Our cash flow, we have ending year cash of $454 million, so our cash increased by $143 million. And to note here is that GASB 68 and 71 had no impact on our cash flow for 15. MTA contributed 100% of their actual required contribution, and we will continue to do so. Just taking a look at some of the additional disclosure, I don't know if you had a chance to notice, but our consolidated financial plan increased from 105 pages to 140 pages, and that's because of all the required footnote disclosure for 6 pension plans. We also had increased RSI, required supplemental information for 6 pension plans. So a lot of information in here on our pension plans. I think everything that anybody could ever ask for is in our pension plans now, in our financial statements. A nice little chart here is a summary of our GASB 68 pension plans. So we see our 3 single employer plans, MAPSTOA, Long Island Railroad Additional Plan, Metro North Cash Balance Plan. And then we see our 3 cost-sharing multi-employer, the MTA DB plan, which is 100% MTA. We have our Neisler's plan, which we're 0.29% of. That's the New York State plan. And then the NYSER's plan, the city plan, we're 24.25% of that. And you can see the funded ratios there for each of the plans. On a consolidated basis, we're 71.75% funded. And just a footnote there, the Long Island Railroad Additional Plan, we do have $140 million of additional funds put aside to fund that, but we're holding that pending approval of the 2015-2019 capital plan. If we put that 140 in, the funded ratio will be approximately 58% for the Long Island Railroad Additional Plan. Just as a point of reference, we have a chart from Bloomberg of the U.S. states' funded ratios for 2014 pension plans. And you can see the top bar up there, the median looks like it's about 68%, and the MTA consolidated is about 72%, so we're a little bit better than the median in terms of a funded ratio. And then finally, we have our reconciliation of the financial plan to our GAAP statement of revenues and expenses and changes in their position. And the big variance there is our labor expense. And, you know, looking at the next page, that's really 2 items up on top. We had lower labor expense because of our most recent actuarial report from our OPEB expense, which went down about $500 million, and that was offset by some higher workers' comp expense. But then you also see the effect of GASB 68, $419 million, lower pension expense because of GASB 68. So you can see where GASB 68 had quite a huge impact on our overall financial statements this year. That concludes my presentation.
Any questions? Seeing none.
Okay, along those lines, we'll have Deloitte come up with representatives of the firm as well to talk about the 2015 consolidated financial statements.
Good afternoon. It's good to be with you here again today. Beside me is Glenn Friedrich, the audit partner that assists me on a number of these various agencies, but I also have at the table today the three managers, the individuals that do a majority of the work on these financial statements, and it's Jill Strohmeyer, Darshan Patel, and Bogdan Gambasu. What I'm going to share with you this afternoon is a hard copy report that we laid at your desk before this meeting started. This is our required communications as a result of our audit of the financial statements. I'm going to summarize the information that's within there. At this point, we are in the process of completing the audits of the MTA headquarters, the New York City Transit and its financial statements, First Mutual Transportation Assurance Corporation or Company, the Long Island Railroad Company, Metro North Commuter Railroad, MTA Bus Company, Staten Island Rapid Transit Operating Authority, and the Triborough Bridge and Tunnel Authority. We expect to issue these financial statements by April 28th in accordance with your bond resolutions to make sure you're in compliance with that information. We are substantially complete with our audit work. We're at this point in the process of just referencing information in the footnotes and wrapping up a few items from that perspective. In terms of conducting the audit this year, we had again conducted it in accordance with generally accepted auditing standards in the United States of America. We also have done it in accordance with the U.S. GAO standards, as these financial statements will be included in your A133 or your Uniform Grant Guidance Report, the single audit report for this next year. As a part of the financial statements, we do provide an opinion on the financial statements, but we're also providing you with an opinion on the internal controls as it relates to the basic financial statements. Pat Kane already shared with you the only change in significant accounting policies this last year, and that was the adoption of GASB 68 and 71. When you read our opinions to those financial statements, you'll see we have a modified opinion as it relates to the adoption of that in terms of a consistency standard, but it is not a qualification of the financial statements. So from that perspective, it's deemed to be a clean opinion on the financial statements. As a part of the audit, we do look at accounting estimates, and I'm going to share with you three of the significant estimates here in a minute in terms of the pension, the OPEB, and the self-insurance liability. There were no changes in any of the methodologies or, for those major estimates besides, again, the adoption of GASB 68. There were no uncorrected misstatements. There are no past adjustments to share with you. Everything that we have identified as a part of our audit have been shared with management. Those types of items have been recorded or were below our materiality threshold. In conducting the current year audit of the TBTA, there was a process where we were basically auditing the financial statements at the same time management was wrapping up their financial statements to be able to meet this accelerated date of your audit committee. Your audit committee this year is 1 week earlier than what it was last year. So as a result of that, we were sort of working hand in hand with them, and as we were going through the audit, there was one audit adjustment that we've highlighted for you at the bottom of page 3, where there was $10.9 million of construction and work in progress that were capitalized because you are allowed to capitalize interest expense on your construction in progress. In terms of other items to share with you on the bottom or on page 4, no disagreements with management in terms of any accounting policies or procedures. We're not aware of any consultation with other accountants as it relates to any matters that are included in these financial statements. We received the full cooperation of management, and again, I think it was a stellar job on the management's process and all of the staff here at the MTA in being able to meet this accelerated time period. In terms of the emphasis of matter paragraphs, in addition to what I've mentioned in terms of GASB 68, you will see on pages 5 through 10 of this document where we also are having an opinion where we're dealing with the summary of other supplemental information, the schedules that Pat shared with you in terms of why your financial statements increased so much. There are some additional schedules as it relates to pension funding and things of that nature in these reports. If you turn to page 10 of this hard copy, you'll notice also some control-related matters that we highlight for you. And again, it's page 10 of the hard copy. It's at the bottom where we say control-related matters. If you recall discussions I've had with you in the past, in the auditing profession, there are 3 levels of significance as it relates to management letter comments. The first is a material weakness, and that is where there is an error in the internal controls or in something else in preparing the financial statements where if management hadn't detected it could result in a material weakness to these financial statements. There are no material weaknesses. The second level of a management letter comment relates to something that we believe is significant that we need to share with you in writing, but it's not something at this point in time that is at the level of a material weakness. And we do have 2 of those matters. One of them I'll share with you as it relates to the preparation of financial statements, and the second one dealing with the A133 audit from the prior year. The third level is a deficiency, and that is just any other internal control observation that we might have. And as we wrap up this audit, we will be sharing our other observations to management of the various agencies in a written form and from in terms of what those deficiencies are. But again, there's only 2 things that I need to bring to you under the professional standards. And those are identified in Appendix B on page 14, and since we're talking about that, I'm going to have you turn to that first before I go back to summarize the estimates. The first item is a significant deficiency, and it's composed of 3 items, but they all relate to the Triborough Bridge and Tunnel. The first 2 items are items that we've shared with you in the past. It relates to the accrual process that agency uses in preparing its estimates of capital and operating accruals, things that have been incurred before year end but have not been paid. And there's a process that they go through in working with the BSC, but also their internal engineers and things of that nature. And we've historically found some items that need to be adjusted either in the surplus report or otherwise as it relates to those accruals. So that's what the first 2 sub-bullets there relate to. And then the third item relates to the capitalized interest adjustment that I already shared with you. Because it was a material adjustment, that is something that then falls under this category. But if I were to summarize this, it really relates to the financial close and reporting process. They've had a significant amount of turnover this past year. In prior years, we've talked to you about bench strength of the various agencies and the process from that perspective. 2 of their key people actually went to MTA headquarters. So, they stayed within the organization, but they had new people that they had to have involved in the process. And as a result of, again, the accelerated reporting, there then was some things that, maybe would have been a little cleaner in the past, but, just if I were to say, crossing I's and dotting T's, they maybe could have done a better job, and that's what that significant deficiency relates to. And then lastly, a significant deficiency as it relates to last year's A133 or single audit report. We'd identified a number of contracts last year that weren't federalized. In other words, they started through your process. They didn't necessarily meet all the federal requirements of bidding and some of the other things that the federal government requires in their contracts. And in this current year, we identified one contract, approximately $10 million, that through December had not been federalized. And in my discussions with management, I believe that will actually result in a payback to the federal government of $10 million. Now, you'll be able to draw down some additional funds, on your own to cover that. But it is something that because of, again, not meeting those federal requirements for that contract, it is a cash outflow of the MTA this next year. Lastly, I'm going to, again, just highlight the significant estimates on page 11. Pat already has presented most of this information for you. We put this in a little bit different format. This might help summarize a little bit some of the other things that you should consider. As he mentioned, a $7.7 billion liability recorded on the financial statements this year. He shared with you what the pension benefit expense was, et cetera. But here in one place, you'll see summarized the key assumptions, the discount rate, the salary increase rates, the expected return on assets by plan. And though any of those items, should they be tweaked by 1% or so, would have a significant impact on your financial statements. And you'll actually see in the footnotes to the financial statements where that 1% impact on the discount rate, what that would do to your pension benefit obligation. As a part of the audit, we do have our actuaries review those assumptions. We test the demographic data information, and we are comfortable with the amounts that have been recorded in the financial statements for those estimates. On page 12 is a summary again of the OPEB liability. You'll see, as Pat mentioned, that OPEB liability increased to approximately $1.5 billion. Again, we are looking at we have our actuaries involved in reviewing that estimate. We look at the rates that are used in discounting that as well, and also the demographic data, and we were comfortable with that estimate. And lastly, the estimated liabilities as it relates to self-insurance. We do have some of our actuaries involved in talking with your people. We challenge management to the estimates that are included, and that liability increased approximately $400 million over the last year. So those were the three significant estimates that I had shared with you in our original plan as to what we had planned to look at. There was nothing new that came up as a result of our audit of any other areas that we felt that we needed to do besides the original plan that we had shared with you. I would be glad to answer any questions.
I just have two. In that significant deficiency area, the first one, the TBA management needs to enhance their year-end process for estimating capital accruals. I found the same comment in the 11 audit report. And the question is, they got better. 12, 13, 14 were good. Then all of a sudden they come back with this comment. You come back with this comment. Sort of just a question.
Actually, that is something we look at every year. I would say that it may have gotten better, but we did have items in the past, but because it's been there so many years, we felt this was the year to elevate it to a significant deficiency.
Okay. And I guess my next question is the payback that we're going to owe the federal government on this contract. I don't remember that's ever happened before.
I will let Bob or Pat maybe address that item.
We refund the money, but it doesn't mean we lose the money. So all that means is that we refund it because it was determined that it wasn't federalized, so we're going to refund it, but we can still draw it down on other capital projects. So it's not really a loss, it's just a...
And let me explain what's happening. As you know, we build into our capital program the expectation that we're going to receive federal dollars according to a schedule, that we're going to receive state dollars according to a schedule. It doesn't always come in according to that schedule. So what we'll do is we will rec and derec. We'll put monies, earmark this funding source for this project, but it might turn out that in the end, we're actually going to apply a different source of funds for that. In this situation, if we knew that we were going to be using federal dollars from the project, eventually we should have started to meet the federal requirements from the very beginning. But we didn't, and someone made an error at the end when they thought that they could then reassign federal dollars to this project. So, as Pat said, the dollars will still be available for something else, but it has to be a federally eligible project. But that's one of the things that we have a very complicated process of applying funds to our capital programs because we don't always have the money at the time that we thought we were going to need the money. So.
Okay.
Any other questions?
No. And with that, Jim, you need a vote?
Yeah. Need a vote to accept the audit as second. All in favor? Any opposed? Carried. Okay.
Good. Next, we have Lamont Kurtz, our Chief Compliance Officer. We'll go over the financial interest reports. Lamont?
Yeah, thank you. As you know, it's that time of year again for us to submit our financial disclosure statement to the Joint Commission on Public Ethics. As of now, we have approximately 7,695 employees who are required to file. As of today, we have not received any notices of delinquencies from the Joint Commission for 2015. However, as I'm sure all of you are aware, the Joint Commission has gone to a new filing system. I've sent out emails and notices. If you look in your book on page 594, you'll see a memo that I sent out to the board advising them of this new system. I'm urging everyone to attempt to file early. Jacob sent out notices this Friday, and we have been inundated with phone calls regarding difficulties in being able to file. I'm not giving any names of anyone who contacted me over the weekend about it. So please try early as we're trying to resolve these issues. The system requires that you have an account with the state, newyork.gov, and we are attempting to make sure that everyone, in fact, has an account that would allow them to access the system. I am also urging anyone who is involved in a profession that is licensed by the state to also file early. There is a new Question 8B. So if you are an attorney or someone else licensed by the state, there's a new question. It's somewhat complicated, probably more complicated than I could describe here, but it is something you should be aware of and start thinking about in terms of the new requirements regarding disclosure of client information. Yes.
Lamont, it sounds like at least 3 of the 5 of us sitting over here have tried already. I mean, it said take a username, and then I assumed the username was my email address from basically what you had implied in the email that we got through Darlene. Didn't work. It sounds like it didn't work for you either. So any more remedial training you can give to some clearly neophytes with this system would be great, because I'd love to.
Well, what's happened is
He seems to know.
Joint Commission attempted to take our entire file list and match it up with already existing newyork.gov accounts. So if sometime in your past you created an account that's still floating in there, that's probably an account it got affiliated with. So if 10 years ago you set up an account, that's it. But if you reach out to me, we'll try to resolve the problem.
What he's asking,
Yes.
what he's asking is, in case you never had a New York, I stumbled my way through it because I didn't have one either, and I had to file for a different reason. But I believe that's what my colleague is asking. How do you get that? Where do you go to get that account? Do it online, and then everything comes at you.
We were assured by the Joint Commission that if you didn't have an account had already been created for you. But if if that did not work, please reach out to me, and I will try to get that resolved for you.
Good.
Okay.
I got the account open. Then they told me the report wasn't available yet,
Right.
so I had to wait.
We have been fielding phone calls and emails all weekend with people having trouble getting in and having other issues. We are trying to work to resolve it.
Good.
But please, try early. Okay? That's
Good.
my report.
Thanks, Lamont. And next, we have Michael Gardner, the Chief Diversity Officer, will come up and brief the committee on the status of his compliance monitoring and performance measures he uses for the diversity and civil rights and tracking his contracts.
Good afternoon.
All set? All set, yes. Afternoon. I wanted to give this committee an update on our closeouts. As of this morning, we have closed out 1,035 projects dating back to 2002. The original backlog was 965. We're focusing now on reaching out to the agencies when projects attain 97, 98%, asking the agencies to forward over to us the documents, the notice of final payment, so we can do our closeout on our projects. We are also working with Lamont Kears, Donna, and Mike on other aspects, including all-agency MWDBE contract compliance policies. So to have a clear understanding of what my staff is responsible for versus what the project management staff is responsible for at the agencies. Out of all of the recommendations that the IG came up with, we have in fact implemented 80% of them, 8 out of 10. The other two that we are currently working on right now is improving the contract compliance system, in which we have contracted out with B2G. And Mr. Vice Chairman, you're right. We are going to have this fully implemented at the MTA during the fall of this year. And we are having weekly meetings with the consultant. And as a matter of fact, next week we're having the meetings with all of the agencies to get their feedback, because this system should not be a DDCR system, but it should be a all-agency system. This is a list of the...
Interrupt you the question?
Yes.
My name having been called. Do you anticipate that system and that data to be on our website somewhere?
On the website, it's going to be it's going to be a portal, but
Publicly discoverable?
yes. Let me circle back if we can have that portal on the MTA's website. The bar chart here it says as of March of 16 that there's been 1,029 projects closed out. That number, as I indicated before, is 1,035 as of this morning. Next page. Site visits. The bar chart is that we are averaging between 44 and 45 site visits per month. That means that the MWDBE managers are mandated to go to at least 8 site visits per month. And so actually, as you see on the bar chart, it's averaging about 44, 45 site visits per month. These are site visits that's coordinated with the agencies because of the safety concerns on some of the construction sites. So the managers are going to each one of the sites and the site visits when the MWDBE subcontractors are there working. The update, as I indicated, B2G, we are having weekly meetings. Every 96 agencies and state authorities are mandated to have the B2G. So there'll be one system for each one of the agencies. And it will allow us to do a more effective job of monitoring the contract and verifying MWDB payments. So part of the system is going to be when the prime contractors submits their payments in this portal, the MWDB subcontractor will then go into the same portal to verify those payments, which is going to cut back on us chasing paper each and every month. Let me, in closing here, I want to thank Lamont Kears, I want to thank the IG's office, and I want to thank Internal Audit, because this issue with closeouts is going to have to be a MTA focus and not just a DDCR focus. So we are talking about having all agency policies with regards to closeouts. Also, let me say that I've also reached out to Internal Audit to circle back around and to verify with a second audit as to the recommendation of the IG's recommendations, and so that's currently being done right now. We don't think a audit or a review is a bad thing. We think it's a good thing when it brings out weaknesses in your processes. And so we ask them to, in fact, circle back around. And that's it.
Well, my only comment is you've come a long way. You've come a long way.
Yes, we have. We've came a long way because of the team approach from internal audit, the IG's office, and ethics as well, and coming together as a team to attack problems that has been lingering for years. So thank you.
Any questions?
Thank you.
Great, thank you.
And with our last item, we're going to go into executive session with the general counsels, and then we'll come out and close the meeting.
Okay, need a motion to adjourn? All in favor? Carried. Thank you.